Good afternoon and welcome to the second webinar, which will be on Workbook 3. Before going any further with Workbook 3, what I'd like to do is to introduce myself. My name's Michael Parry. I'm the Director of the PFM Education and Training Programme and therefore responsible for all aspects of the programme. Let's get on with looking at Workbook 3. Workbook 3 gets more complicated than the previous workbooks. And it covers quite a number of different areas. First of all, how ledger accounts make accounting practical, and then from those the trial balance, and then creating financial statements from the trial balance. And then fourthly, the cash flow statements, and 5 other double entry concepts. So ledger accounts first. Ledger accounts, as this illustrates, were originally the name given to manuscript accounts kept in a book. The ledgers were pages in a book, referred to as the ledger, and there was one page, a ledger for each category of asset, liability, revenue or expense bank accounts, and you'd have a separate ledger account for each separate bank account, motor vehicles, which would normally be grouped together, and then items such as rent, sales, other assets and liabilities. Why do you have ledger accounts? Well, in Workbook 2, we recorded the series of transactions by showing the impact of each transaction on the balance sheet. That simply isn't feasible if you have a large number of transactions. So ledger accounts provide a structured system for recording large numbers of transactions. Now, they were obviously developed for a manual system, but the concept is still used in a computerized accounting system. You still have to enter your transactions, your sales, your purchases into the accounting software. The software itself will then normally apply the double entry and create the ledger accounts as reports from the system. So if you're using a computerized system, it takes away much of the complexity from your perspective and does it for you. But if you're an accountant, you need to understand what the system is doing, and the principles are exactly the same as the manual system we will describe here. The basic premise of any ledger account is that the debits and credits are used to identify the two aspects of the transaction. The actual term debits and credits doesn't mean anything. You could have called them negative and positive, plus and minus, but the traditional word, which is always used, is debits and credits. And every entry you make, every transaction you record, must balance so that the money value of the debits equals the money value of the credits. Debits equals credits. As we said, in a computerized system, the software will do that for you. Now then, this table summarizes the total debit and credit rules. This is all there are. There's nothing else to learn. There are 5 categories of items: assets, liabilities, capital, sales revenue. Sales will be when you're selling things, but a government will have revenue in the form of tax revenues, for example, and expenditure. And each one of those can increase or decrease in any transaction. And these rules define which type of movement is referred to as a debit and which is an increase as a credit. So, for example, if an asset increases, if you buy a motor vehicle, then you debit the asset of motor vehicle. If an asset decreases, for example, cash goes down to pay for the motor vehicle, then that's a credit to the bank account. And remember, in any one transaction, there must be a balancing debit and credit. They can be within the same category. For example, when you purchase the motor vehicle, one asset, the motor vehicle goes up, another asset, the bank account goes down. Or they can be in different items. For example, if you make a sale on credit, the asset of account receivable increases, which is a debit, and you have a sales revenue increase, which is a credit. So they will always balance. Now, it's easiest to look at that using the example we had in Workbook 2 of Ahmed's transactions over 8 days. What we'll do, as the Workbook does, is set up the ledger accounts for those transactions. The first one, and arguably the most important, is the bank account. Now notice that there are two receipts into the bank accounts, the initial capital and then the loan receipts from Ahmed's father of $20,000 and $5,000, both shown as debits. And there are a number of payments for the motor van, for fixtures and fittings, partial payment of the amount owed to Branson, and the rent paid. And those are all credits. And then we balance the account. Now the concept of balancing is that you simply add up the larger side, in this case the debit side, which comes to $25,000, and then you put in on the credit side the figure that you need to make that equal to 25,000. So in this case 15,100 is the balancing figure that you need. That's the figure at the end of the day. It's shown on the credit side, but if you think about it, it means that the debits exceed the credits, that your receipts have exceeded your payments. And therefore, when you bring it forward on the other side as a debit to show the balance brought forward of $15,100. Easy to envisage that if you look at it as a statement. So you have the debits, the increases of $25,000, and the credits, the decreases, totaling $9,900. The difference is the amount that you have in your bank account, $15,100. Now, bank accounts present a particular problem of understanding because it is normal to refer to a bank account as being in credit if you have money in your bank, whereas we're saying that it's a debit balance. The reason for this is best understood by looking at it from the perspective of Ahmed on the one hand, who has an asset of $15,100 and therefore a debit balance on the bank of $15,100, and the bank, which owes Ahmed the $15,100 and therefore has a liability. When you receive a bank statement, you are getting effectively a copy of the bank's ledger account with you, and therefore they show themselves as owing you the money, and in their books it's a liability, it's a credit. The next ledger we've got is the capital account. The only entry in this we show is the initial capital of $20,000, which is a credit, and that's the amount carried forward of $20,000. So a credit balance into the next period. Note that we do not show the profit at this stage. Under the ledger accounting system, you calculate the profit at the end of the period. So at this stage, we don't show the profit in the trial balance. And we will see in a few minutes how that works. And then we go through the rest of the ledger accounts. I'm not going to go through every one of these. You've got them in your workbook. You can see how they work there. But it follows the same principle. Each transaction is entered, and each transaction will be entered in two ledger accounts, one amount on the debit and one amount on the credit side, so they always balance. So we go through, we have 10 ledger accounts in total, 10 types of transactions, and then we use those to create the trial balance. The trial balance is a single statement which summarizes all the ledger account brought forward balances at the end of the period. They're actually the end of June 8th, but they'll be the opening balance on June the 9th. The trial balance is important for two reasons. First of all, it's an arithmetic check that the accounting entries balance. A trial balance must have equal debits and credits if you followed the rules correctly. If they don't, you've made a mistake, and you have to go back and identify it. And secondly, as we'll see, the trial balance enables the preparation of financial reports. And as we said, the initial trial balance does not show any profit or loss. So we have the 10 ledger accounts listed down the left-hand side, and the balance on each ledger account, and they do balance, we've done it correctly. They have a total of $30,800 on each side. Now at this stage, that's nothing more than a statement of what's already in the ledger accounts and an arithmetic check. What it does give you is it gives you the chart of accounts. If I go back, that list down the right-hand side is reproduced here and is our chart of accounts. It's simply a list of the different ledger accounts. And in a simple system like we've got, there are just 10 ledger accounts. In a computerized system, the chart of accounts would actually be a table to which all transactions are related in order to generate the ledger accounts. So it becomes particularly important when we look at a computerized system to develop a chart of accounts. But in a manual system, the ledger accounts are in fact the chart of accounts. Notice also that in that list, it's a mixture of balances and flows. There are 3 flows which are ringed here: purchases, sales and rent. All of the other items are balances. So obviously to create the balance sheet and the profit and loss account, we have to separate the flows and the balances. We do that and calculate the profit using an adjusted trial balance. Now this is much more complex to look at, so I'll explain the columns. The first pair of columns on the left, debits and credits, are simply a repeat of the trial balance we had a moment ago, totaling 30,800. The next pair of columns are the period end adjustments. The third pair of columns is then the net of the trial balance and the period end adjustments, and then we subdivide that into the profit and loss account and the balance sheet. Notice all the way across each pair of columns, debits and credits always balance. Now, how does this work? Well, in this one, we've only got one adjustment, which relates to the purchases. Now, the purchase is the amount that we've spent to buy goods, but actually those goods are being used in 2 different ways. Some of them are still held as stock, and some of them have been sold. And we actually know from the information we were given that the amount that was sold cost $1,200, and therefore the balance in stock was $7,800. Very often you do it the other way around. You count your stock and value it, and then the difference would be the amount, the cost of the goods sold. But however you get to it, we divide it up between the amount that's left in stock and the cost of the goods that have sold. Notice those 2 adjustments balance. We've simply divided the 9,000 into 7,800 and 1,200. And so in the adjusted trial balance, we don't show the $9,000. Instead, we show 7,800 and 1,200. The 1,200 is the flow. It's the amount that we've sold. The 7,800 is the balance that's left. So the flow goes into the profit and loss account columns, and the stock goes into the 7,800 columns. And notice that we've now got, I haven't ringed it, but we've now got a figure for profit. Basically, you've got to have that figure to make the balance stay the same, but it is in fact your calculation of profit. And we'll see how that works in a moment. So suddenly, out of this simple trial balance, by making period end adjustments, we've actually generated our profit and loss account and our balance sheet. Which is actually really rather clever. So 2 financial reports, balance sheet and profit and loss account, are generated from the trial balance by adding the adjusting columns. Now, our only adjustment here was for the amount of inventory or stock, US and British terminology. You'd also have other adjustments, for example, depreciation. And remember, the adjusting columns must always balance. And we said we've got a balance sheet, but obviously the way it's presented in that trial balance isn't very suitable for publication. So we reorganized the information into a more conventional format where we show the fixed assets, motor van and fixtures and fittings, the current assets, inventory, debtors and cash at bank. The current liabilities, creditors or accounts payable, to get the net current assets, the long-term loan, which we deduct from all of the other assets to get the net asset figure of 20,300, which equals the capital employed, including the $300 profit. So now we've got the profit. And you can see all of that comes from the columns in the trial balance. These are the columns in the trial balance we just saw, and they can all be linked so that every item in that balance sheet, other than the calculated subtotals, derives from the figures in the trial balance. And similarly with the profit and loss account, again, we present the information in a more conventional manner here. Say it's sales less the cost of sales, 1,200, giving a gross profit of 600, less the rent expense, giving a net profit of 300. And again, we can relate that to the columns in the profit and loss account, in the trial balance. We've simply reorganized the information and introduced a subtotal. But that shows the calculation of the net profit, which we actually had in the balance sheet. I'll say it's really a remarkably neat and clever way of doing it. It's mainly applicable to manual accounting systems, because in a computerized system, again, the computer will do that for you and generate your balance sheet and profit and loss account. And it's important to understand what the balance sheet and profit and loss account are. The balance sheet is the statement of values, accounting values of assets and liabilities, the net assets and capital at a point in time. So a balance sheet must always be dated as at a particular date, in this case June 8. Whereas the profit and loss account records flows over a period, so a profit and loss account must always identify the period. 8 days ended on June 8. Because the balance sheet reports values, the profit and loss account reports flows. And I've added a column here just for information. The International Public Sector Accounting Standard name, IPSAS as their commonly known name, they use the term statement of financial position for the balance sheet and statement of financial performance for the profit and loss account. Part of the reason for that is that obviously in the public sector you don't have profits, and therefore you can't refer to a profit and loss account, so it's called a statement of financial performance, and for consistency they call the balance sheet the statement of financial position, which actually makes it very clear that one relates to flows and the other to balances. Now those are two of the very important financial statements. The third is the cash flow statement. Cash flow statement records the flows and balances of all forms of cash. And if you recall in Workbook 1, we defined cash as being notes and coins, bank balances, and very short-term, highly liquid investments, normally investments that mature in less than 3 months. All of those are treated as cash, and the cash flow statement will show the flows of cash over a period and the major category. Notice the cash flow statement does not record assets or liabilities or any adjustments to their value. So it doesn't show you the amount of stock, for example. You can have more or less stock, but the cash flow statement only records cash flows. And in the case of Ahmed, he's only got one bank account, so the cash flow statement is effectively a restatement of the ledger account in a conventional format. This format is the format used in IPSAS 3. It's also the format that's used by the IMF Government Finance Statistics, so it's an important format. It's obviously been designed particularly for organizations in the public sector, but we could apply it also to Ahmed. There are no receipts. That's counterintuitive, because you'll say, well, surely there were sales. There were, but they were on credit. So within this period, you haven't received any money, any cash for sales. So as far as the cash flow statement goes, there were no sales. We did pay out $5,000 for purchases, not $9,000. That's the amount of the purchases, but the cash we paid was the amount we paid for them, which was $5,000. Rent was paid in cash, and the receipts less those payments is the net cash flow from operating activities. And then we have what are referred to as investing activities, which in this case is the acquisition of fixed assets, both van and fixtures and fittings, to get the net cash flow from investing activities. And then we have financing activities, which are the capital introduced and the loan. We brought together the capital introduced and the loan into one category because they're both methods of financing a business. The net cash flows is the net of the flows from operating activities, investing activities, and financing activities. $15,100, which is, of course, your cash at the end of the period, because in this particular case you had no opening balance, it was a new business. Notice also that the cash flow statement actually mixes up two things. It mixes up balances and flows. So everything above that red box is a balance, and then in the red box we show the cash flow and to get to the balance at the end of the period. I said that that's kind of derives from the ledger account. Again, we can see that if I use the statement format of the ledger account, because it's easy to show you, which we had earlier on, you can link that to all of the items in the cash flow statement. So again, it's just a matter of reorganizing the information into a standardized format. One of the exercises you will have to do later on in your course will be the calculation of cash flow and preparing cash flow statements. They can often be quite difficult, but it is one of the components of the financial statements of an organization. Now finally, I want to go on to some other double entry concepts. This is a rather miscellaneous collection of different things which we haven't covered elsewhere, and so they are put in this section of the workbook. First of all, control accounts and sub-ledgers. If you think of a manual accounting system where you have a ledger book, which is a bound book, and if you have a large number of transactions and perhaps a large number of customers, it becomes impossible for one clerk to manage making all of those entries manually. But because it's in one book, you can divide it up. You've got to keep handing the book backwards and forwards between different clerks. The way around this was to create sub-ledgers. For example, you would have a sub-ledger for the amount owed by individual customers, accounts receivable, as they would be called in the US, or debtors in the UK. And so you will show in your main ledger the control account, the total amount that is owed by customers, and then in the sales sub-ledger, you will show the amount that is owed by individual customers. In a manual system, the challenge is to make those two figures balance. But in a computerized system, the computer does that for you and there's no problem. Now, there are various reasons why you may want to set up sub-ledgers in a computerized system, which I won't go into, but the concept is shown in that diagram. It's simply a subdivision of a main account. Daybooks. Daybooks, again, in a manual system, you would very often have your sales being recorded at some remote office, entered onto a notebook, which would then be passed to your central accounts function, which would then enter them into the ledgers. And in order to do that, they would keep what is referred to as a daybook or a notebook to record those transactions. Nowadays, with computerized the tendency is to put direct access to the system at the point of sale, or you could envisage, for example, a tax office receiving tax receipts in cash, that you would have a system where those are directly entered. So it is effectively a daybook, but again, it's recorded, it's contained by the computer within the computerized system. The second item on this page is journals. Journals serve a particular function. There are many transactions which will occur which don't fit into the standardized sales and purchases. And if there's no standardized way of recording an item within your accounting system, and this particularly applies actually to computerized systems, then you'll need to set up a journal for it. The journal records the entries in terms of dollars and specifies the ledger accounts to which they identify. So it's generally used for transactions that are not sales or purchases. Well, I haven't stated it here, but obviously in any journal, debits must equal credits, the basic rule. So our example here is a motor vehicle is purchased for cash, $3,000. So you debit the motor vehicle account, you credit the cash, the bank, and you put a brief description. All computer accounting systems will have a facility to make journal entries because there will always be a number of transactions which don't fit into the standard formats. Depreciation. Again, we haven't had any depreciation in our example, but it's something you'll be familiar with. Depreciation is a charge for the consumption of a fixed asset. A fixed asset is an asset which has a life of more than one accounting period, but in each accounting period you will make a charge which is the amount of that asset that has been used in the period. And usually it's done, well, invariably it's done in relation to the original cost of the asset. So if we look at the example here, the motor vehicle costs $3,000. If we say we're going to depreciate it at 10% for a period, let's say a year, then the charge will be $300 depreciation per accounting year. $300 is debited to the depreciation account, which is an expense account, and it is credited to the motor vehicle account. So it reduces the value of the motor vehicle. And because that reduction in the value does provide an approximate indication of the fact that the vehicle will be worth less as it gets older, but it is not intended to be an accurate valuation. That's simply an incidental benefit of depreciation, if you like. There are many different ways of calculating different depreciation. We just don't get into those at this stage. Everything we've looked at so far in the workbooks has been based on accrual accounting. Accrual accounting records all transactions in all types of assets and liabilities. An alternative approach is cash accounting, which only records cash flows and balances. In fact, it only generates the cash flow statement, which we saw earlier on. You do not have asset and liability accounts. Commercial operations have, for many centuries, used accrual accounting. It's become the standard way of accounting for commercial entities, whereas governments have traditionally used cash accounting. They've only accounted for cash and cash flows. And for many, indeed perhaps most countries, that's still the case. Somaliland uses cash accounting. The USA uses cash accounting, to take an example at the other end of the scale in terms of size, whereas the UK uses accrual accounting. The tendency is, the trend is for governments to move from cash to accrual accounting, but there are arguments for and against that, which we'll look at in the PFM for Somaliland course. So at this stage, just be aware that we are looking at accrual accounting. Cash accounting is the system generally used by governments. It's simpler. All you actually have is you have the bank ledger and you have the cash flow statement. So if you could do accrual accounting, you could do cash accounting. And finally, just a list of the different forms of business enterprise. Commercial entities normally operate in one of three formats: a sole trader, a partnership between several persons, or a company. A company is an organization where you have separated the ownership of the company and the operation of the company. And the owners only have limited liability for any debts of the company. Hence the use of the term in the UK limited company, whereas in the USA they tend to use the term incorporated to show the company has been incorporated under law. Same thing. No difference with those two terms. They mean exactly the same thing. Public sector entities, there's a range of these. Obviously at the top you've got government entities, the government of Somaliland. And you also get some national levels of government, regional, for example, state governments, such as in Somalia, you've got the state of Puntland, for example, as a state government, and local governments for municipal or rural areas. The exact structure varies between countries. Within a government, you will have ministries, departments, and agencies. Again, the structure varies between governments, but each of those can be an entity and produce its own, have its own accounting system and produce its own accounts. You don't have in Somaliland, but there do exist in other countries, social security funds. They are recognized as a separate category of public sector entity. For example, funds set up to manage the pensions of government employees. So the fund is controlled by government, but it has its own flow of revenues and its own expenditures within very limited, legally defined boundaries. The fourth category is public corporations. The terminology here is very confusing. Public corporations is the term used by the UN and the IMF to describe business organizations that are controlled and owned by government. The IPSAS, the International Public Sector Accounting Standards, refers to them as commercial public sector entities. Most governments tend to talk about them as state-owned enterprises. All of those terms mean exactly the same thing. There is no difference between them. They are simply different names for the same thing. And finally, you have other public sector entities such as universities, which will be part of the public sector, although their relationship with the government will vary from country and institution to institution. Okay, that concludes this presentation. Thank you very much for listening.